Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Christopher Mills of Harwood Capital, one of the UK's finest small and mid-cap investors. So welcome, Christopher.
Good morning, Paul.
When we last spoke back in December, you were relatively cautious on the outlook for 2023, but we've had a relatively strong start to the year for the first 5 months, despite sort of a mini banking crisis. What's your outlook for equities overall now?
Well, I suppose that's a fair statement, but I think one really needs to analyze it a bit more carefully. So if you take, for example, the S&P index in America, which, you know, you can say is up 10%, that sounds pretty good. But if you take out just 7 stocks, the 7 mega cap big tech stocks, the index is barely up at all. You know, the Russell, much more reflective of you know, the US as a whole, is flat. You know, the FTSE has its ups and downs, but year to date it's broadly flat. Yeah, that doesn't sound to me like some raging bull market, and I can tell you, because we have a lot of AIM stocks, and they're definitely down quite a lot.
Yeah. So if the breadth does widen, is it likely to drag up the rest of the market, or is it basically just a sort of like a bit of a swan song before the sort of like the realization that we're going to have a sort of like a tougher macroeconomic environment in the second half?
Well, that's certainly our opinion.
Okay.
I think, you know, what you've seen, particularly in UK small cap, is, you know, very substantial redemptions across the class. I think now the counterweight to that has been, you know, a swathe of takeovers, which we benefited from quite a lot. I'll give you some examples of things that we've owned that have been taken over. And we see that continuing over the balance of the year. So,
well,
you know, for example, names.
Go on.
So I was going to say names that, you know, we've talked about in the past would include Crestchick, which was taken over.
Yeah, big thanks there, big thanks there, by the way, Chris, because you gave me a lovely Christmas present heading into December. I mean, I know your team had worked sort of tirelessly, the likes of Richard Staveley and Nicholas Mills behind the sort of scenes on the board there to sort of get that ship sort of turned around over the last 3 years. So yeah, a big pat on the back and a big thanks for that takeover, because myself and my family benefited greatly from it.
But it's more thanks to them. I was responsible for I was actually involved in the negotiations with the Greco, and I think I can fairly say I got you the extra penny.
Well,
because
yes, so that tipped the balance.
That's a very funny number.
I did wonder why we got that extra million on top.
So anyway, I think that's very much where it's going to be. You know, I think interest rates in the United Kingdom, I'm afraid, are going to have to go up some more. They certainly will go up in Europe, and it's my personal opinion they're actually going to go up in the United States too, because, you know, employment numbers there are still not consistent with reducing interest rates anytime soon. And then I think also, I think people are going to be surprised about inflation. I don't think it's come down as fast as people expect. I think there are sort of 3 headwinds to that. One of the more obvious ones is we're reshoring businesses. And that is not going to be conducive to particularly lowering inflation. I think secondly, you know, we're all trying to green our economies, and that comes with, you know, upfront costs, which are not going to be conducive to inflation. And then, of course, the wage increases will take time to work through the system, while people still play catch up. So I'm afraid I'm very much in the camp of higher and longer. I don't see that changing.
Yeah. So on that basis, if you've benefited from some good M&A there. I mean, obviously there's a long list of companies that have sort of taken out and sort of like putting some cash into the Harwood capital funds, etc. Where are you looking to deploy, or are you sort of like putting it into sort of money market funds as a sort of temporary parking lot?
No, we are slowly but surely deploying it. Unusually for us, we actually bought and sold Dowlais recently, which was that spin out.
Oh, GKN.
Yeah, that's right. On a bigger note, we think Ascential that's breaking itself up is quite cheap, around 235. We bought a few Chemring, again on the basis it trades a big discount to its private market value. And when we start going through some of the names that we own, like Hargreaves Services, we are actively buying the stock at the moment because we think the whole thing's utterly potty, to be truthful with you.
Right.
And when we go through a number of these companies, valuations sitting out there just make little or no sense to me.
Yeah, no, I think you raise a really, really good point, because I've been a reluctant bear over the last sort of 4 to 5 months, but I've turned to a sort of cautious bull, largely on the back of valuations, because there's just so many attractively priced small and mid caps, and it makes me bullish if you've got a sort of longer 3 to 5 year outlook.
Yeah, and obviously we do.
So on that basis, one sort of like real sort of feature of these sort of Harwood funds is you sort of mix a bit of sort of like private equity with the listed stocks. Do you want to take us through what's sort of like the investment thesis of doing that, and sort of like the key advantages of having some sort of privately held companies in the portfolio?
Well, I think one of the important points to stress about our private equity is that, unlike nearly everybody else, we don't have any technology. In fact, we don't have any technology of any sort. Our businesses are businesses that we'd be more than happy to own in the public domain. It's just the opportunity arose in the private domain. So I'll give you, and the other aspect is that in our opinion, as a lot of these technology businesses run out of money, they're going to need to take severe down rounds. So there is an inherent overvaluation sitting in the whole sector waiting to hit. On the contrary, if you look at the sort of businesses we own, just by way of example, we own an oil service business in the Permian Basin. We value the company at $20 million. It has absolutely no debt. By the end of June, July, well, then it's year end, about $5 million in cash, and we'll be earning, well, at the current rate, it's earning $6 million, but we expect that to slow down a bit. But we're earning at least $5 million of EBITDA, and about $4 million of that is free cash. So we're valuing the business at 3 times EBITDA, which is obviously very conservative. Another one we have is a company called Spring, which is a healthcare business. Spring is currently valued at £40 million, about 26 million of equity and about 15 million of debt. Last year was exceptionally good, and the EBITDA on the pharma side was about £12.5 million. So again, less than 4-time valuation.
So what you're saying, Christopher, is if you're an investor, you're a shareholder of the Harwood funds, etc., the listed sort of like investment.
Particularly North Atlantic is the fund that has all these things.
Yeah. So what you're saying is that effectively the valuation in the net assets for the actual fund is significantly conservative, even on very limited sort of multiples.
Yeah, and I mean, I'll just give you a few other things like we own. We own the third largest medical packaging business in the United Kingdom. We're currently valuing it at 58 million. Assume that NASC, North Atlantic, is about 25% of each of these businesses. Sometimes it's a bit more. That business is being valued at 58 million in our books. there's no guarantees here, but we have an offer on the table at 80 million. Another one is called Wengen. That's in the books at 28 million. That does management of properties. The current bid is 38 million. We have a pet care business we've also put up for sale. We valued at 80 million. The first bid came in at 110 million. So there's quite a lot of latent value in this portfolio. We have a defense business, which we're also looking to sell. It makes components. It also has one of the few testing facilities to stop Chinese and other fake components entering the US military. That's being valued at 8 times EBITDA. Source Bioscience got delisted. That's sort of being valued at 8 times. And you could say that Medica was a partial comp. So we've got all these kind of really boring businesses, but they're all actually doing pretty well at the moment, and we think this is a good time to harvest them.
How would you harvest them, Christopher, in terms of the liquidity to be able to exit? Would it be looking for a trade sale or an IPO? I mean, the IPO market is obviously dead.
No. These are all trade sales.
Yeah, okay.
So the pet business is going to private equity group. Pet business private equity group in America. The medical packaging business, the bid is from a French packaging business. The Wengen one is overseas. Well, it does the same thing in Europe as we do. So now look, all those things can fall through, but the point I'm trying to make is that the valuations we put on these things are sensible and conservative. They're not the sort of 70 or 100 times earnings of some of these tech companies, even if they have earnings.
Yeah.
Or some fanciful multiple of sales. It's not what we do.
Yeah.
And, we're just hopefully going to do a new one, which we're buying for 6.3 times. Really nice little business with 70% of the business is in food ingredients. Food ingredients is quite a high multiple business, as I'm sure you're aware.
Yeah. Good. Okay. Well, just turning now to the listed stocks. One I know it's sort of the right at the top of most investors' watch list is EKF Diagnostics. Do you want to take us through your latest sort of view on that business? Because it seems to have a rock solid point of care diagnostics division, and then it's adding on the sort of like the life sciences and sort of enzyme fermentation arm out in the States.
Yes, I mean EKF has basically had to reposition itself after COVID, and that's it resulted in it closing down facilities, making people redundant, and that's cost us quite a lot, to say the least. But as you said, the diagnostics business, where it's a global leader in testing for basically, cells in your body. Basically, it's a market leader in that. It's a market leader in testing for ketone acidosis. It's also got a good diabetes testing business. And those businesses, hemoglobin is what I was looking for. Those are fundamentally good businesses. We're now basically getting them back to the sort of margins that they should have been at, because some costs crept into the business while the COVID thing was going on. And as you correctly say, company used the bounty that they received from COVID testing to invest in an enzymes business, because Mike Slater has a background of enzymes, having worked in being head of GE's enzymes business, having come out of Amersham. And that business is now really starting to gain traction. The facilities should be commercial by the end of the third quarter, perhaps a little earlier than that. And they are in discussions with major new clients to start filling that up. And that could be a very, very exciting business for the company. I mean, remember, we're already in that business, providing enzymes to such large companies as Roche. But this is a very, very material step up. which could add very materially to our EBITDA over the coming years.
Yeah. Where does that extra volume go, Christopher, in terms of the enzyme fermentation?
It goes to two, basically enzymes are used, ironically, in food manufacturing and pharmaceuticals.
Yeah.
So, and what we've created at EKF, we believe is actually relatively unique, because there's very big enzyme companies like Eli Lilly who produce it by the hundreds of thousands of gallons, and then there's small universities who produce very small quantities. So to have a company that can actually produce relatively short-run enzymes for smaller manufacturers is, we're led to believe, we are one of very few in the world.
Right.
Certainly in the United States. So look, the company's still got a good balance sheet. It's got good businesses, but we have to unwind the COVID issues, and that's proved expensive.
Yeah. Well, I'm certainly looking forward to hearing how the business progresses over the sort of the next 6 to 12 months, because it seems to be priced to very reasonably at the moment, with all the upside not in it. So let's wait and see. Now, another one you mentioned I
think it just goes down to this just total lack of interest in small cap, and if you're doing sort of a turnaround as well, just zero interest. It's just silly, but it is what it is.
I know people probably wouldn't agree to it, but you could certainly see somebody putting a big number on this business, having 100% plus premium on one day, because it does look significantly undervalued on some of the parts. Now, another one, which was a turnaround when you pointed out 3 years ago to me, and I'm still kicking myself for not buying it, is NIOX, which was the old Circassia business that my dad did have foresight to follow you in on it. And it's moved from I think it was 25p when you first sort of bought, or right at that sort of level. And now it's over 60. What's sort of driving this sort of asthma sort of diagnostics business?
Okay, but I think the real point is that you started from a business that was in desperate need of some new management. And Ian Johnson, who obviously we know extremely well because he's one of the Harwood advisors, went in with Michael Rollo, who we also know extremely well, because remember we all sat on the board of BioQuell together.
Yes.
Basically went in and he just did the obvious things, which was he just right-sized the business. So he's reduced the corporate overhead, or the cost of running the business, from early 30 millions to 14 million, and apparently if it was taken over, another 2 million of that would come out. So you could say underlying 12 million. He then has focused on rebuilding the sales effort, which is now really, really working. So they're talking about 20% increase in sales this year, with another 15-20% next year.
And what's driving that top line, Christopher, in terms of?
Well, basically, the test itself is by far and away the best test in the world. COVID hit the company hard because to do the test, you either have to attend at the hospital or a GP, a specialist GP. So people weren't doing either. So that certainly hit the market. And then there's a reasonable market in China, because the Chinese, like everyone else, has got lots of asthma. And then that market closed down, as you know, and all these things are starting to reopen. So if this company is being run really well, it's a cash machine. They've got 600 million tax loss carry forward.
600 million?
You heard right. 600 million got thrown away in this company.
Wow.
We expect the cash by the end of the year to be up to about 30 million. And the test is unique. They have sort of 95% of the world market, but the penetration into the world market is still only about 5%.
Right.
So that's why when I first started talking about it, it was riskier because cost base hadn't been reduced enough. I think a lot of people know this story now, so I think it's getting up there. Now we think there's further to go, but the real money has really been made on this one now, in my opinion.
Yeah, well done. Big pat on the back again. Certainly from my dad anyway, because he's benefited tremendously from it. Now, just moving to sort of like all things sort of kidney diagnosis. We've got Renalytix and Verici. I think Renalytix have basically got, is it FDA approval for their sort of like early stage sort of chronic kidney?
Okay, so no, the story of Renalytix and Verici are both the same. They're both in the FDA. Renalytix to get approval of the product, which has taken way longer than anybody thought. Now, I was speaking to the chief executive at the end of last week, and one of the things that has held things up is that this will be one of the first artificial intelligence-based diagnostic tests that have ever been approved. And I don't think many people realize that, and certainly
I didn't know it. No,
that was going to create as many complications as it has. But we're reasonably hopeful that it will be done in the relatively near future. It's kind of the same story with Verici, where the principal product is called Clavara.
Yeah,
I think something like that. And basically, that again needs to get approval. And that also is due within the next few weeks. So by the time we speak next, you'll either be speaking to me or not, but these are big weeks for both those companies.
Yeah, I think the Verici came out with prelims today or final results, and actually I think their Clavara sort of prognostic is not getting FDA approval. I think in the next couple of weeks is getting sort of major clinical validation study data at the end of June, which is pivotal. So I think that's the sort of the big news.
But that ultimately leads to approvals.
Yeah. Good. Okay. Well, I mean, I think both those businesses are really high potential, and they've been absolutely battered, haven't they? As I think most biotech stocks across the world equally have been sold off unfairly in a lot of instances.
Well, it's a very tough marketplace out there for them at the moment. That's certainly for sure.
Yeah. Another one which is we've talked about before, but not that often, is Benchmark, which does sort of like animal health for sort of like salmon and other seafood and stuff like that. Do you want to take us through your latest thesis and views on this one? Because again, it's been a sort of like a high potential company that is sort of like struggled to sort of like really reach its potential.
Well, I think the problem it's had is it took longer than people expected to get the salmon lice product. They got hit by COVID because people weren't going to restaurants, so they weren't eating so much shrimp. So they had quite a heavy headwind. They had a lot of businesses which really weren't central to the core, which had to be cleaned up. And the business now actually is in a pretty good place. Now, it's easy to get confused with this company because the accounts are actually quite complicated, but they're getting themselves into a pretty good place. Now, if you see the numbers, you think, oh God, this company actually loses money. Well, actually, it loses money because, well, first of all, you've got to get to the accounts. So if you take the EBITDA number for this year of 36 million, there's 15 million of amortization of goodwill against that. There's then 10 million of amortization of R&D, but going forward, no more R&D is being capitalized. So again, that's real money coming into the company. The big capital expenditure cycle is behind them. So the 20 million depreciation is now looking at capex in future of 6 to 8 million according to the company. And they also have, believe it or not, a 7 million tax charge.
For a loss-making business,
For a loss-making business. So actually this company is actually in much better shape than people think it is. Looking at September 25, we're looking at sort of 50 million of EBITDA. hopefully they can start fixing their taxes a bit better. And, you know, EV/EBITDA of 7.5 times, which is completely the wrong price for a world-leading life sciences company for animals. Well, for the fish industry.
Yeah. Is it a trophy asset, this one? As in, like, is it something that is effectively unique with a lot of IPR that somebody else would be very interested in integrating within their existing businesses?
Oh, I'm pretty sure if this was put up for sale, it would get a very high price. The problem you've got is you've got 3 large Norwegian holders who sort of have different views as to the future, but they probably don't see it as a trade sale anytime soon. And that also means you've got a very illiquid stock.
Right. So
no obvious exit in a liquid stock does not make for a happy share price.
Yeah, it does. This seems to be, you're exactly right in terms of, it seems to be a very attractive area, because you look at Zoetis out in the States, which I think is trades, it's one of the world's biggest sort of animal health, sort of like pharmaceuticals types companies. I think it's on about 25, 30 times EBITDA. So this is obviously, you know, a very, very rich and fertile investment ground.
Well, as they make salmon eggs, let's hope that it is fertile.
Okay, yeah. Well, you do get sort of like these diseases, don't you, with fish? Now, just turning tack to sort of like
no, they are one of the world's largest. They're one of the world's largest producers of salmon eggs, which get fertilized to create salmon. That was the joke. Sorry.
Yeah. Now, just moving tack to industrials and distributors, Avingtrans, again, another one you sort of like highlighted about 3 years ago, done very well. It certainly seems to be sort of powering ahead in all things sort of like nuclear and energy and sort of like good visibility. And then it's also got this kicker that you mentioned, which was the Magnetica and healthcare sort of small form MRI. Plus, they've got, I think, a small stake in Adaptix, which does this sort of like the similar in X-rays, etc. Do you want to take us through your latest views on this one? Because I think it's got a year-end trading update probably in about a few weeks' time.
Yeah, I mean, look, the company's doing absolutely fine. They obviously need to, you know, we absolutely believe break up value of the industrial assets and the cash and the property is, you know, £5 a share, possibly a weeny bit more. You know, our number for the medical businesses, we've just come up with a number of 13 million, which takes you to £6 a share. But Singer's estimate that the value to the medical business today is 50 million, which would take you to £6.60 a share. But if you just ignore the medical side, you're really underwritten by some very good businesses here. And the one that's really interesting over the next couple of years is probably Metalcraft, which makes boxes to store nuclear waste.
Yeah.
And they are the absolute dominant market leader with virtually monopoly. Now, they know they can't maintain that, but there's a £900 million contract coming up in 2025 from Sellafield, which will certainly secure that business.
Yeah.
So my best guess is that they'll probably sell the doors business next, which they bought for nothing, but they turned around.
Yeah.
And that's probably worth, you know, something between 15 and 20 million. Cash and the properties, you know, we probably get 25 million. So, you know, this is a management team who deliver on what they promise, i.e. they take distressed assets, they clean them up, they turn them around with a view to selling them. It's been a very consistent story there. The medical side, I suppose, came as a bit of a surprise because it's sort of not consistent with that. But, you know, when you speak to them, they are very convinced there's very significant upside in medical.
Well, yeah, there's certainly plenty to look forward to. And I think with your expertise adding on to it as well, Christopher, then when it comes to sort of M&A and some of the parts on their existing businesses, the industrials, that'll certainly help if you sort of do anything, you repeat what you did with Crestchick, and likewise with the medical, with the life sciences view, then I think they're onto a bit of a winner there. So you'll have to stay on the board there, Christopher.
No, we're not on the board of this one. Roger McDowell's on the board. He's one of his biggest person.
Oh, okay.
And obviously, we know Roger very well indeed because I sat on the board with him at Augean.
Yeah.
But no, the one we actually are on the board is Hargreaves Services.
Yeah, let's turn to that one because it's another sum of the parts play, isn't it?
Well, I mean, in our view, the whole thing's just ridiculous. I mean, in fact, it'll be announced shortly. We're actually buying shares at the moment. We can't buy very many because we're taking 30%. But if you look at this thing, the tangible, stated book is £6, I think it's 5p or something like that.
Yeah.
We believe that the breakup value is well over £7, and the stock's £3.90.
Yeah.
I think brokers' estimates for the current year are sort of 80p.
Yes.
But if you understand the balance sheet, there really isn't any debt at all. In fact, there's net cash. There's a lot of leases, and those leases are based on the HS2 contract, but that equipment gets returned and taken off the balance sheet when that contract ends. So if you exclude that, they've got nearly 30 million in cash. And they're absolutely focused on delivering value for shareholders. So at this price, strip out the cash, that's about 80p a share. You've got a stock on a P of 4, yielding, well, I think dividends 22 or 23p this year. So, that's over 5% even at £4. And as I said, we feel very comfortable with believing that the breakup value is over £7. And I think they started referring at their capital markets day the other day that they have potentially significant value in their renewables assets, which no one gives them any credit for at all.
Yeah, it does. I mean, it's certainly with the three divisions there. What's difficult, I guess, for sort of investors, I guess it's a bit of a suggestion. It's difficult for investors to get full sight of that value creation opportunity. So if you ever speak to these guys and want them to come and to explain what the upside is or what the business is all about, then the door's always open there, Christopher. Because even I'm a value investor and I'm struggling to sort of really understand all the moving parts.
Yes, we do have better insight into that than you. I agree with that. Yes, I'll mention it to them.
No, another one that I think Roger McDowell is the chairman. I know he's taken a sabbatical, but is Flowtech Fluidpower, which is I think it was perfectly positioned heading into the pandemic. Obviously, got hit with the lockdowns. It does sort of like pneumatic and sort of fluid power devices and services in the UK. A distributor. But the business has sort of struggled, I think, to generate cash and consistent growth. What's sort of like the latest on this one? Because I think it's just got a new CEO, hasn't it? I think, or Mike England.
Yes, this was a major coup. They got in Mike England, who was the chief operating officer of RS Group, which I still think of as a components, but was a sort of FTSE 100 company. And I mean, I think we all believe he's an outstandingly good manager. The stock is certainly not expensive. It's trading a discount to book. P for this year's earnings of about just under 10, going to 8. EV/EBITDA, 6 to 5.5 times. And I think it was quite interesting today. It was just announced that he just got his LTIP, and he got 1.6 million nil paid shares. But to achieve that, there's 1 million is at £2, give or take 400,000 is £2.50, and 200,000 is at £3. And he's got to achieve those prices within 5 years. So if you just take 5 years, add in the dividends, it comes to sort of an IRR over 5 years, sort of 16%, just to get to the £2 number, because the stock's about 108 today, so it's just under a double. And as I said, the thing has a dividend yield. And to get to the highest number, you're looking at an IRR of 25% over the period. I don't think he would have taken the job if he couldn't achieve these numbers. So we think the stock's dirt cheap. Again, we're slightly constrained because, we own, I think, give or take 30% of the company across various funds, because Rockwood owns it, we own, Oryx owns it, and Stewart owns it. So we think it wasn't a bad business. We think Mike England will make it a much better business. And he's clearly got the incentive to do so.
What about sort of like generating the cash? Because it has got sort of like, I think it's about 23 million pound of net debt, which is roughly round about sort of, just working the maths, about 1.8 times EBITDA.
Yeah, that's right. They're starting to generate cash now. The inventory got slightly out of control. So we're expecting, and they're basically saying they're going to prioritize cash generation over higher dividends. So we're kind of expecting the debt to fall to sort of 18 this year and 16 next.
Yeah.
But if at the same time, obviously, if you look at sort of brokers' forecasts, and we think those are conservative, you've got a 24 number of nearly 15 million of EBITDA. You've got the net debt to EBITDA down to about 1 times, and that becomes very investable.
Yeah.
It's not bad at the moment at 2 times, but certainly we are highly supportive of a strategy that will get the debt down rather than pay its dividends.
Good. Okay. Now, again, just turning to another one, which I think has got sort of like a bit of net debt that it needs to reduce, is Maintel, that I think has also sort of like, it's moved its CEO on recently. And it does sort of like, I think it's a provider of cloud and managed communications, IT services in the UK, good recurring revenue streams. But again, it's got a growth platform, but hasn't actually sort of like delivered as much as potential as perhaps its potential.
Okay, well, we've actually met the new CEO, Carol Thompson, 3 times already. So,
okay.
Because we weren't amused about the profits downgrade last year, as you could imagine.
Yes.
In all fairness, some of the problem was self-inflicted, and some of it was inflicted on them by supply chain shortages. Anyway, focusing on the future, because we have actually been buying some of these recently, we feel very comfortable. I mean, Carol's talking about making 7 million this year, and the way she's phrasing it, I suspect it could be a weeny bit higher. She certainly was talking about 10 million being attainable over the medium term. I don't mean 100 years' time. I mean perhaps within 2 to 3 years. And she believes she can restore, somewhere between £4 and £5 to shareholders, within a 3-year period. Doesn't seem entirely crazy, because if you said, should focus on paying down debt, £5 in 3 years' time probably represents an enterprise value of £80 million. And 8 times EBITDA for a business like this, and by the time you take out public company costs, you're probably talking, 7.5 times, is not an excessive valuation for a third party to buy it.
Yeah, yeah, and there has been a history of some good consolidation across this industry, hasn't there, in the past?
It is consolidating all the time.
Yeah, and I mean, I would highlight to investors as well.
The whole point is anyone who buys it can take out a huge amount of cost.
Yeah. They're basically anything below gross margin, I guess. I would highlight to investors, actually, that one other big feature of the Harwood funds is that, when companies do sort of like go through a tougher period, then you guys certainly do step up to the plate and, sort of like, try and right size and get the ship back on course. There's no doubt about it. So that's a real positive, I think, for investors. Now, just turning to the sort of property and house builders, MJ Gleeson, I know that's been in your portfolio for a very, very long time. What's your sort of outlook of sort of like the, sort of housing market and the more affordable end that MJ Gleeson operates at?
But before we sort of get into MJ Gleeson, the housing industry at the moment has a lot of headwinds at the moment.
Mm.
One of the principal ones is the UK planning budget for collective local authorities. In the 1980s, since the 1980s, the budget in real terms has fallen by 75%.
Wow.
So, surprise, surprise, there is a shortage of people. That slows down everything. And it tends to also mean that the very bigger plots get approved because that kind of gets approvals through. But it is meant for people like Gleeson that the time frame for getting a planning approval has gone out from a few months to nearly 2 years.
Right.
The second thing, as I'm sure you're aware, is that planning approvals are becoming very political.
Mm.
With the Conservatives taking away the need for councils to have land that can be developed, the Liberal Democrats absolutely getting on that bandwagon and using it as a stick to hit the Conservatives with, which means the Conservatives ramp up their anti-planning rhetoric and remove the government's leverage over local councils. So, ironically, if a Labour government's elected, it might be helpful to the housing industry. And then you've got just new regulations coming in, like nutrient neutrality. The estimated impact on that is something like 120,000 plots just aren't fit for purpose at the moment.
Right.
To put it all together, and it's not a very happy, the government says let's build more houses, but you need the planning permissions and you need to deal with some of these issues. And then, of course, the house builders have got to pay for the cladding issue, which doesn't exactly boost their cash flows to go and build more sites. I mean, certainly for someone like Gleeson, who still perceives itself very much as a growth house builder, that makes it tough because if the government's taking away 28% of your profit, and to start a site, a Gleeson site, probably costs about £3 million by the time you've bought the land, done the planning permissions, and the working capital involved. If the government's taken away 15 million of, another 10 million of your money in taxes, there goes 3 sites, and there goes the ability to build another 90 houses a year. So, these aren't problems that are specific to Gleeson. And as I said, Gleeson still very much perceives itself to be a growth house builder. But like any other house builder, obviously there's the other headwind of rising mortgage rates. So, it's going to take a bit of time to get back to that rapid growth trajectory. And, it's in the market, already in the market, they've come and said that, they expect the number of houses completed this year to be down. Having said that, this is probably the first time that Gleeson, for a very, very long time, Gleeson is actually trading at a discount to tangible book.
Yeah.
And, if you basically believe the housing industry is cyclical, that will resolve itself, and for all house builders, but Gleeson is probably the only one that has the ambition, and indeed we think the right demographic, to continue to actually increase the volume of homes it builds over time.
Yeah,
I would guess sooner or later there'll be another scheme from the government along, Help to Buy of some sort. Because first-time buyers, given current mortgage costs, etc., are certainly going to need some help.
Yeah. No, I'm with
there
you.
Again, rates.
Yeah, I'm with you.
Rising.
Sorry, Christopher.
I was going to say rents are also rising quite fast, which of course actually then pushes them back into home ownership again.
Yeah.
So is there an easy fix at the moment? No. But as I said, it's fundamentally a very good business with a very good management team who know what they're doing. We were very lucky to get Graham Prothero out of Vistry. And the whole of the team is very dedicated to deliver on the future growth targets.
Yeah. Yeah, I'm with you. I think, as long as you take a 3 to 5 year view and recognize that the housing market is cyclical, then you're probably going to do well long term. And it's just going through a tough patch, over the next 6 to 12 months. Now, just turn into sort of prop tech on the market. I know you talked about this one, which is a sort of like a challenger property portal for the likes of compared to Rightmove and Zoopla. Do you want to take us through your latest thoughts on this one?
Well, I have to be missing the plot here because this thing is so cheap that I have to be missing something. Market cap today is 50 million.
Yeah.
Basically, they've come out and confirmed that they expect to be in line with forecasts for 2023. So we're looking at an EBITDA of 7.7 million. And it's got no debt and 10 million in cash. So for a business that's projected to grow its EBITDA by about 20% per annum, I just don't get it. If you take Zeus's forecast, for example, the 2025 forecast is 42 million in sales, 13.3 million of EBITDA, and finish the year with 21 million in cash. So not the 21 million of cash off, you've got 30 million, and a business trading at 2.5 times EBITDA in a sector that trades at 12.5 times EBITDA. In fact, more. I mean, it's just, to be honest, utterly inexplicable. Now, I know part of the problem is that for the first time, a number of the agents are able to sell the stock.
Yeah.
Because when they started, as an inducement, they gave agents stock, and now that period's coming to an end. And that has created a drip onto the market, again in a very illiquid stock. And that's the only thing I can put it down to.
Yeah.
They're spending money on, improving their platform, providing additional services. Sadly, I haven't had a meeting with them recently. We're due to have one in the relatively near future. So more than, but as I said, it makes no sense. So either I'm missing something, because you don't simply buy businesses like this at less than 5 times EBITDA, historic, once you strip out the cash.
Yeah, well, you can. I mean, if you've got people or a group of investors who are selling the shares, because of the estate agents, then in an illiquid market, it's going to have a disproportionate effect, isn't it? And so you can have a huge disconnect between price and value, and that's probably what it is, I guess. And one company that again is sort of like needs a bit of Harwood magic is Tribal Group, which used to be a bit of a darling of sort of like all things technology and software related in the education sector. I think it does sort of like all the sort of the bookings and the organization software that runs universities and higher education places, and also does some exam testing. But it's had a bit of a problem with a contract out in Singapore of late, which has sent the shares into a bit of a tailspin. But they're if they can right the ship, then presumably the outlook is back on track.
Well, there's always two sides to what happened with the contract. What the company's side is that they basically sold for the purpose of this a Volkswagen.
Right.
And the client constantly gave change orders, which inferred they wanted a Porsche.
Oh, okay.
But weren't prepared to pay for it.
Right.
And so basically the whole thing ended up in an impasse with the company basically unable to go forward. The Singaporeans saying, we're going to sue you. I don't know where the lawsuit will occur. Let's hope it's not Singapore, because that probably wouldn't be as good as if it was held in England, shall we say.
Yeah.
But, you know, market cap's now 80 million. There's cash still a bit of cash if you exclude the leases. And, you know, for what it's worth, you know, EBITDA is meant to recover to 12 million in the current year, and you could probably say, excluded public company expenses, 13. And educational software businesses don't trade for 6 times.
Yeah.
So we added meaningfully to our position at 40p, which is where it is now.
Well, certainly in terms of if they can get that ship sort of right sized and you know, sort of moving in the right direction, I guess. Yeah, if you look at the sort of the balance sheet, if there isn't anything coming out of these contracts, then you know, further, then it should all be systems go, I guess.
Yes, look, as you said, it's fundamentally a good business, and it's got good recurring revenues. You don't see the top line growing so fast because they're getting rid of legacy contracts which didn't have recurring revenues and replacing them with sort of SaaS-based systems.
Yeah.
So the quality of the business is improving as well as the quantity of it.
Yeah. Well, I wouldn't be surprised if there's a trade sale there at some point in time, given the valuation. If somebody took it on board and knew what they were doing, then you'd get lots of synergies, and you would realise that value, crystallise it quite quickly. Just moving now to sort of the leisure and entertainment sector. We've got to 10 Entertainment, which I think is the UK's largest sort of like 10-pin bowling, or one of the largest 10-pin bowling operators. And I know with experiential leisure, then that seems to be going gangbuster at the moment. People want to go out and enjoy themselves.
Yes, I mean, it's actually the second largest after Hollywood Bowl.
Oh, is it? Oh, okay.
But not that far behind. I mean, 10 is just another example of what's going on in the market. Before COVID, the stock was £3.30. The EBITDA at the time was about 24 million, heading to 28 million. And I can't remember, but there was something like 15 and 20 million in real debt. Forget the leases. Today, I think the brokers forecast are for 40 million of EBITDA, forgetting leases, so real money. The company's got no debt, 10 million in cash, 5 million in a property freehold, and the stock's £2.80.
Yes. Trades on less than 9 times.
Well, no, actually, it's pretty close to 4 times EBITDA when you split it. When you say it's only less than 5 times when you take out the cash and the
sorry, I meant a PE, about less than about 8.5 times PE, something like that.
And then the dividend's been restored at 10p. But again, you know, it's just another small cap where nobody cares, and you know, sometimes you feel slightly sorry for the poor old management who are doing a brilliant job, but you know, their equity incentives, you know, don't end up being worth very much.
At the moment, anyway. These things will change with a bit of luck.
But I mean, one of the things you're completely right about is 10 offers, you know, a very cost-competitive entertainment proposition. So, you know, a family of 4 can have a meal, have bowling, and have a sort of other activities for about £60 in total.
Wow.
And you know, the company's strategy has been to keep food prices down because the rest of the business has got, you know, very good margins. So we can use the rest of the business to subsidize the food offering, which makes us an attractive place to stop and eat now.
Yeah, well, you can't even get a pizza around where I live for less than 60 quid. So that sounds like a pretty good value proposition. Now, just moving to sort of some of the asset managers. You mentioned Frenkel Topping again about 3 years ago, and it seems to be doing quite well. And Polar Capital. Do you want to give us your latest views on both of those?
Yeah, they're very different stories. In fact, you might have seen Frenkel Topping today announced that it just got another trauma center.
Yes.
So it now manages 9 of the trauma centers in the United Kingdom out of the 28. And that's important because it gives us, or gives the company, immediate access to the person who's been damaged in the accident. Very much with an agenda of taking them through all the services that Frenkel Topping can offer, and it's not just fund management at the end of it. Fund management comes at the end of it. You know, getting the help in the trauma center after, you know, your loved one has been hurt, making sure the family through the company's charity, you know, has food on the table that night, etc. And then seeing them through costings, long-term care, short-term care, witness reports. So the fund management bit's very important, and it's growing rapidly. But basically, this is almost a totally integrated backwards fund management business. And certainly in the industry, it's totally unique. There's nothing like it.
Yeah.
Brokers forecast for the current year's EBITDA of about 8.6 million. And the market cap today is about 90 million.
Yeah.
So more expensive than many of our stocks, but a really good growth trajectory with the company forecasting that it believes it can double its sales over the next 5 years.
Well, I guess with elective procedures coming back as well, then it's only going to be another tailwind for the business.
No. Elective procedures coming back sadly does help, but not a very happy way, because that basically drives more clinical negligence, which drives the other half of the business.
Yes, that's what I
meant.
meant.
The business is split between trauma, where someone's fallen off the back of a motorcycle, for example, or fallen off a ladder and broken their back, and clinical negligence, which is cerebral palsy, for example, which is a tragic thing,
right?
Where a kid can't. You don't really. Cerebral palsy can take 7 years before you can really assimilate the damage done to the child.
Right.
So, the company has to deal with some of the most hurt people in society and do it in a sympathetic way.
Yeah.
And that's one of the reasons why, if we can get everybody to understand, we can provide all the services in a way that we understand their needs. We believe that will be very good for ultimately building the funds under management business at the end of it all.
Just turning out to say Polar Capital, I know you sort of like you highlighted it. It was a tech play, wasn't it? As a good cheap way of getting into tech about 2 or 3 years ago.
Well, and it still is. Sadly for me, it's got a bit cheaper. I mean, Polar, I'm told the dividend is safe, so you've got a stock just over 500p. That value's coming up 500 million.
Yeah.
The liquid assets 145 million, and a dividend yield of 9. I still believe Gavin Rogerson is one of the most outstanding builders of fund management businesses I've ever met in my life. And remember, we worked together at J.O. Hambro Capital Management. And so actually we've been buying a few more Polar over the last few months. And the other advantage is, as you know, we're not really tech investors here. And so investing in a fund management business, which is, very driven by its tech funds, made a lot of sense to us and still does.
Yeah. Well, it should
if
be
you buy all these technology companies at 100 times earnings, and you're buying Polar at making it up 11, 12 times earnings,
yeah.
With the dividend yields, it makes sense in our mind.
Yeah, but it also should be doing pretty well out of generative AI, I guess. His portfolio should be rising. Another one in terms of volatility that should do well as a sort of like a hedging play is ICAP. It's the interdealer broker, world's largest, I think it is. Again,
that's correct.
It's sort of trading at really sort of low levels of 6 times PE. With sort of like, not negligible debt. In fact, it's just a neutral balance sheet.
Well, actually, it's by the end of this year, it's going to have net cash.
As
a whole. But P is 6, yield of 8. We believe, my understanding is that they're still trying to figure out how to deal with some tax issues, because at one stage they were talking about spinning out part or all of Parameter, and that hit some tax issues. That business continues to grow and is very valuable. It's a platform business. We think that's worth the whole of the current share price.
Right.
Which means you're getting about 150 million of profit for free, no PE. The disappointment there is that Liquidnet, for which they paid a huge price, has turned out to be a major mistake, in my opinion. Certainly never justified the price they paid for it, at least in its current earnings. And it's still going sideways. But the good news is that the most profitable part of the TP ICAP's trading business is tied to interest rate movements. And I don't see any slowdown in volatility and interest rates anytime soon.
Yeah, I mean, it's been absolutely just interest rate movements have just been incredible for the first 6 months of this year. So you'd have thought that would be really sort of jump starting that trading activity. I mean, just look at the US yield curve. It's been all over the shop.
Correct. That's where they make the money.
Yeah, exactly. Another one in the sort of financials, just to sort of like finish this section off, is Conduit Holdings, which I think is a sort of like a class. Well, it's a Bermuda-based reinsurance business for sort of property, casualty, and catastrophe. Now, given the we're just starting the hurricane season, what's the sort of the thesis on this one?
Well, I don't really remember this, but actually, I think I discussed this with you.
Yes.
6 months or a year ago.
That's right, you did. Yes.
Actually, the stock's actually done quite well since then. The story now, because again, we're still buying this stock, is there has been and continues to be one of the biggest increases in insurance rates, particularly property casualty insurance rates, particularly excessive loss catastrophe, that anyone's seen pretty well forever.
And why is that, Christopher?
Okay. So, series of low interest rates, too many hurricanes, loss of all the planes in Russia have just basically, A, made the business fundamentally unprofitable, B, drained capacity out of the market, and then inflation arrives and insurance companies with tails, which Conduit doesn't have, are suddenly finding the cost of treating people going up.
Right.
So you had a kind of a perfect storm, and now that storm is completely reversing. So, and on top of it, the insurance companies all lost money on their bond portfolios last year because interest rates went up so much.
Yes.
So, Conduit had a big loss on its bond portfolio, but actually the average maturity of the bond portfolio there is only 2.4 years. So those losses are now starting to reverse. New bonds they're putting on are obviously very much higher yields. And the marketplace itself is just as hot as it can be. And, we know quite it so happens, I know Neil Eckert, the chairman of this company, and I meet with him relatively frequently. In fact, as recently as about 2-3 weeks ago. And you've now got virtually the perfect storm the other way, where interest rates are now much higher than they've been for 14, 15 years. And rates are going through the roof. And because the rates go through the roof, that creates an even bigger shortage of capacity, if that makes sense to you.
Yeah.
So, people are talking about further increases in rates next year. And, Conduit, which is trading at effectively, little more than, it'll be about this year's end book. Expected to earn 60p plus this year, which covers the dividend for the first time, 2 times. And then, brokers' estimates for 96p next and 105 the year after, which would take you down to a P of 4 and a bit, 25% discount to the book value. And if you look at the sector as a whole, most companies are trading at sort of 1.4 to 1.5 times book at the moment. Because what I'm telling you, everybody knows this.
Yeah, no, you're right. The maths works, yeah.
Now, what I suspect is that people are playing the bigger names like Munich Re, that's performed very well recently of last year, Swiss Re well, but not very well. But again, all those stocks are trading at big premiums. And a Conduit, which is not a small company, 800 million.
Yeah, no, it's $1 billion market cap. Yeah.
Yeah, but that's not big. But the
no,
good
you're
news
right.
is they've still got quite a lot of capital they can still deploy to build that book over time.
Yeah, I mean, I'm totally on the same page because, and I think you really highlight an excellent point that I certainly hadn't realised is that Conduit and probably also ICAP. I mean, they're relatively liquid to get into, but they are actually benefiting from the reduction in liquidity in the market by the central banks, because as liquidity is withdrawn, then it reduces the sort of available capital for the big insurers, and it sucks that out, and therefore it makes the pricing firmer and the volatility of interest rates even higher, which would boost TPI. So I think I hadn't appreciated sort of like beneficiaries of liquidity withdrawn, and both of those, I guess.
Yes. But it's not just that liquidity.
No, you're right. No, you're right. Yeah.
There were a lot of hedge funds who were basically trying to play what they thought was easy money, by writing catastrophe bonds, and had their head handed to them.
Yeah.
And the other thing that's I think interesting about Conduit is they've assumed that all their plain exposure to Russia is worthless. And that's not true of some of the other insurance companies.
Right.
So
Okay.
if they're wrong and the other ones are right, that would be a nice uplift for them.
Right. Good. Okay, that's an excellent one. Now, just turning sort of from the size side, we've got to real micro cap. That I'm amazed you'd be able to actually get liquidity in is REACT, which I think is a sort of cleaning contractor for sort of like health, education, rail, and the highway sector. It's about sort of 50...
You're right. We've gone sublime to the ridiculous.
Yes.
Yeah, the answer is we kind of pick up stock from some fund manager who's got a redemption and just can't be bothered with something that's liquid. Market cap is about 14 million, but there's an earn out of 2.4 million. So you're looking at 16 million roughly. But EBITDA in the current year would be 2.4, and we think that's conservative. And then if it was a private company, it would be nearly 3. So you're looking at what we consider to be a growth business trading on somewhere between 5 and 6 times. The business they're most excited about is called Ladders Free, which is basically cleaning commercial windows for major companies.
Right.
That is the principal part of the EBITDA. Probably 1.5 million comes from that, and that's a very high recurring revenue. The hygiene and maintenance business would be about 600,000, of which 85% is recurring revenue. And then they have a business called Emergency and Decontamination, which is basically it's a project-based business. Some disaster happens, or a pharma factory gets E. coli or something like that, and you have to go and decontaminate it. That's the smallest component of the business, but it has a very, very good margin, 20% EBITDA margin around that, and that does about 300,000. So we like the management team here. We met with them recently. They believe over the next 5 years they can double the EBITDA, which again, suggests a 15% rate of return, and hopefully at some stage you get some improvement in the EBITDA multiple. So for the long-term investor, we think this is a very interesting business, throws off lots of free cash.
Yeah.
Because as soon as that earnout is paid off, then the capex isn't huge in this thing, and you'll start either to build up sizable cash balances, or hopefully find some small add-on acquisitions in the businesses they're already in.
Well, they made good margins, as EBIT margin of about 10%, which is pretty damn good, I would have thought. So they've obviously got something.
Yeah, no, it's a nice little business, and so far they've delivered on all their promises.
Okay, just sort of finishing up, we've got what's on the sort of the Chris Mills radar. I know I think you mentioned sort of like Spire Healthcare is one, and then sort of a property and real estate maybe another area that is sort of like piquing your interest.
Okay, so we like Spire a lot. So again, we were talking with management within the last 2 months. Basically, the story behind Spire is it's a mixture of demand for their services rising, and the management team is now really focusing on maximizing the revenues out of what it's got. So for one example, they basically said, we're going to be moving out of cosmetic surgery,
right,
into more hips and knees, where that theatre time will be more valuable. So just like in entertainment, they have a box, and they say, what do we put in that box that makes the most EBITDA? Spire is doing exactly the same with its hospitals. So we think that's absolutely the right, sensible thing to do, and will ultimately result in, better margins, higher EBITDA, and in my opinion, a better business. The thing is stuffed with assets. The stock is trading at about 8.6 times this year's EBITDA, which is kind of in line with the long-term average. But if this strategy comes off, again, looking at a couple of years, that falls to 6.6 times. So, that gives the opportunity to make, a 30% uplift just by things staying as they are without any multiple expansion. What, however, is interesting is a company called Mediclinic has been taken over.
Yes.
And Mediclinic owns 30% of Spire. Now, logically, Mediclinic either bids for Spire or sells Spire. It makes no sense for a private equity house to own 30% stake in a public listed company. So we think you have a reasonable prospect of being taken over, which is in the shares, and you're not paying for it.
Agreed, yeah.
And for what it's worth, I mean, comparable companies like this, and okay, there aren't many comparables out there, but our private equity side had a business which basically looked after children who needed caring needs. And and I appreciate interest rates have risen since then, but we've seen these things go for 11 times. And that would be a big uplift from where we are today, and obviously a very big uplift from where we would be in 2025. So you've got a good a business that's, we believe, a fundamentally good business, a business that's getting better, and a valuation which isn't excessive, i.e., you're not being paid for the event of a takeover, and I honestly don't think you're being paid for the acceleration in the growth either.
Yeah, the upside. Well,
and it's not great, but they've started to pay a small dividend.
Well, just as another just another data point, my father and my stepmother have both been using Spire and bought shares because of the back of it, because they realise it's a growth industry, particularly with elective surgeries coming back, and there's no capacity in the NHS.
Well, and then the other side too, which I don't think is generally known, but the management are actually very open when you talk to them. Is they were talking that their owned hospitals, they have a big owned hospital estate. If they were to be revalued to current valuation, would be a 600 million uplift.
Right.
Which given the market cap's only 900 million, that's quite sizable, shall we say?
Yeah, agreed.
And the debt that you look at is all this leasing debt on the hospitals they lease. If you strip that out, the balance sheet's actually quite sensible.
Yeah, yeah. Just one stock that I know you talked about 2.5 years ago that traded suspended. I'm not sure how you sort of like whether you still hold it at all. Is WANDisco? You did mention at the time it was a total punt, which is. But I was just wondering if there's anything which investors would could learn or sort of pick up that from trying to monitor situations like this.
Okay, well, we bought it as a total punt. It wasn't working, so we sold out at. We lost 30% of our money. We sold out at £2.90. We obviously certainly didn't know the whole thing turned out to be a fraud. It's just the sales weren't coming through as promised, and so we gave up.
Right.
Obviously, they did come through as promised, except they weren't real. So actually, it's kind of a funny story. Well, it's not funny at all. Actually, it's really bad for the market because £1 billion companies probably gone close to zero. But if you look at it, when the news came out, we were still on Bloomberg in one of our funds owning 1 million shares, which would have been 6% of the fund. So we had to put out a press release saying, actually, it's a mistake. We sold out over a year ago.
Bloomberg are wrong.
Bloomberg are wrong. You briefly mentioned real estate. I mean, we're looking at some of there's a lot of REITs that are actually slowly but surely realizing they're too small and breaking themselves up.
Oh, right.
So
okay.
We made a bit of money on Circle Properties. The one thing we think is interesting at the moment is real estate investors.
What real estate investors?
Real estate investors, yeah. Symbol REI. Stock 30p. The dividend is 2.5p. The last NAV is 62p. The debt at the end of last year was 70 million, but again, we've had a lot of discussions with the management, and they expect that to get that down to about 50 million by this year end, and are hoping to get most of the debt away by the end of 2024, when the company's interest rate fixes expire. That'll leave you with about 100+ million of assets. There isn't an institutional market at the moment, but when it returns, I don't believe this management team, who own a lot of shares themselves, won't be receptive to either sale of the whole company as a whole or in parts.
What type of property do you own?
Oh God, it's all over the place. From shopping malls, they're shopping, streets of shops, shall we call it, or shopping centres, where they're selling the shops off one by one. Then there's some property that needs to probably get planning permission for housing, and then there's sort of industrial and commercial properties, nearly all in the Midlands area, where the can't remember if he's either chairman or chief executive. No, he's chief executive. A guy called Paul Bassi has operated successfully for many, many years. So that would be an example of one that we own, which is very cheap. The other one we own, but it's less cheap, is Palace Capital. But it's the same story, all being sold.
Yeah.
But no, I mean, real estate investors, particularly as, Bassi has a big personal stake in the company. He bought a lot of shares around this price. He's openly saying that as and when he gets his debt down, he's going to go into the market and buy more shares. Right. Although, frankly, I think that's going to be tough because it's not particularly institutionally held.
Yeah.
And as I said, you're getting an 8% yield while you're waiting.
Yeah, both of those look sort of fundamentally undervalued. In fact, a bit like Hargreaves Services in terms of potential unbundling and realising value.
That's the problem with the market at the moment. There's tons of stuff that's cheap. It's not so easy to buy it, though. That's the snag.
Yeah.
It's both difficult to buy it and difficult to sell it.
Yeah. As long as you're patient, that's capital.
Challenge I've got.
Yeah. No, so thanks very much, Christopher, for all those brilliant insights. I've certainly learned a ton. Now, if people want to put some money into Harwood funds, how best to do that?
Well, I mean, North Atlantic, nearly all our funds are quoted. So North Atlantic's quoted, Stewart's Edison's quoted, Rockwood's quoted, and we were delighted that Richard won the Fund Manager of the Year award last year.
Yeah, I saw him last week actually down at the Mellow Investor event. He did a brilliant presentation that I suggest people have a look at his slides. And
we had a bit of excitement last week because North Atlantic is now going into the FTSE 250.
Oh, is it? Congratulations!
Yeah, so. Took me quite a long time to get there, but we got there in the end.
Yeah, well, the shares have done well, haven't they, over the last sort of this year, that's for sure. Certainly from the October lows.
Yes, no, they have. Well, I think the takeover bids have helped, and no, that's quite pleasing. And we're starting to pay dividends in North Atlantic. I can't promise we'll pay every year, but we paid one last year, and it's highly likely we'll pay another one this year. It's not big, but it's an improvement on nothing, which has been the case for a long time.
Well, with a sort of like a long-term track record of good teens annualized returns, then I don't think you can get that anywhere else to a certain extent. Not over a sort of 50-year or 40-year sort of like longevity. So well done there, Christopher.
Yeah, no. If you look at what I started with now, it's 4 million quid to 700.
Yeah, that's not a bad return.
But what's exciting here is we've got, at least in my opinion, some really good fund managers operating in this space. I think we're probably now one of the stronger houses. Certainly, not many people would commit as much resource to operating in these small companies. And it's really encouraging to see Richard and Stuart do so well. And, I've got to work harder to keep up with them.
Well, I'm just sort of monitoring what you guys are doing because you bring out such fantastic businesses and, in terms of opportunity wise. And if in the event that some of them do sort of like, struggle for a short period, then you sort of roll up your sleeves and get involved and make sure that they get back on track relatively quickly. So I think it accentuates the upside and reduces the downside. So a lovely combination there.
Well, thank you once again for all your time.
Yeah, no, thanks very much, Christopher. And again, love to touch base again in 6 months' time.
Absolutely. Have a lovely summer.
Take care. Thanks.
Thank you. And you. Bye.
Bye.